Which one would you choose, VOO or SCHD? In this video, I'm breaking down the performance, the dividends, the holdings, and exactly what a $100,000 portfolio looks like in each. Plus, at the end, how each one would survive another 2008 style crash. Let's start with the only thing that really matters. That's the performance. VOO is Vanguard's S&P 500 ETF. It tracks the 500 largest companies in America. And over the last 10 years, it has returned an average of 15.47% per year. SCHD is Schwab's US Dividend Equity ETF. It holds about 100 hand-picked, high-quality dividend stocks. And over the same stretch, it has returned an average of 12.37% per year. So on pure total return, VOO has been the clear winner. Over 3 years, VOO returned 20.58% versus SCHD's 13.52. Over 5 years, it's 13.36 for VOO versus 8.51 for SCHD. Now, why is there that gap? Really, it comes down to VOO having tech. VOO is loaded with the mega cap tech names that have carried the market for a decade. SCHD deliberately avoids most of them. It's not trying to win a sprint. It's kind of playing a different game, and you'll see why in just a second. To put it in real dollars, $10,000 invested 10 years ago would be worth about $39,000 in VOO today, and about $30,000 in SCHD. That's with dividends reinvested. That's the growth story. But growth is only half of this battle. Now let's talk about the reason most people even consider SCHD in the first place, and that's the dividends. SCHD currently yields about 3.28%, while VOO yields about 1%. That means SCHD is paying you roughly 3 times more income on every dollar invested. On a $100,000 position, SCHD pays you around $3,200 per year in cash, while VOO pays about $1,000. That's not really that bad considering everything these ETFs are holding. But here's what most people miss. It's not just about the yield, it's the growth of that yield. SCHD has historically grown its dividend by around 9.15% per year. VOO's dividend grows too, but at a slower pace of around 6.5% per year. That means the check SCHD sends can definitely keep up with inflation depending on the current numbers, and you only buy it once, and your pay raise shows up automatically every year. Now, popularity. VOO is one of the largest funds on the planet with about $1 trillion in assets under management. That just happened this year in 2026. SCHD is roughly at $98 billion, making it one of the most popular dividend ETFs in existence, and both are dirt cheap to own. VOO charges about 0.03%, and SCHD charges about 0.06%. Fees are a non-issue for both. This fight kind of gets decided elsewhere. Everything I'm showing you in this video, the charts, the back tests, the portfolio breakdowns, I go way deeper on all of it inside the Boring Money Club on my Patreon. That's where I share my actual portfolio, monthly portfolio updates, and the stuff that actually builds wealth. If you want to invest alongside a community that's playing the long game, the link is in the description. Now let's check out how these funds are weighted by their holdings. VOO's top holdings are exactly who you'd expect. The mega cap tech giants, Apple, Microsoft, Nvidia, Google. These top 10 make up about 39% of the fund. You are making a heavily tech-weighted bet, whether you realize it or not. Look at the sector breakdown. Technology is roughly 39%. That concentration has been rocket fuel on the way up. But remember that number because it's going to matter when we go through the crashes. SCHD looks nothing like that. Its top holdings are companies like Merck, Home Depot, and United Health. Businesses that sell things people buy in every economy. Medicine, food, energy, home improvement goods. Its biggest sectors are healthcare at 20.77%, consumer defensive at 20.64%, and 14.13% in energy, with only about 12.72% in technology. And here's a stat that kind of surprises some people. The overlap between these two funds is tiny. Only around 48% of their holdings are shared by name only, and even more staggering, only 8% by weight. These are genuinely two different portfolios, which is exactly why so many investors end up owning both. All right, let's make this real. So you've got $100,000. What does life actually look like in each fund? With $100,000 in VOO, you'd own about 145 shares. Your annual dividend income is around $1,000 a year. But if the next decade looks anything like the last one, that 100K could grow to roughly $334,523. With dividends reinvested, we are seeing about $390,000. With $100,000 in SCHD, you'd own about 3,000 shares, paying you roughly $3,200 a year in cash. Money you can spend, reinvest, or use to pay bills. Grown at its historical rate, that 100,000 becomes 218,000 in 10 years, plus every dividend along the way. With dividends reinvested, it would grow to about $300,000. So the $100,000 question is really this: do you want the bigger number on the screen or the bigger check in the mail? There's one scenario that choice matters more than any other: a full-blown market crash. It's September 2008. Lehman Brothers collapses, the financial system nearly implodes, the S&P 500 gets cut in half, a drawdown of over 50% from peak to bottom. If you had $100,000 in VOO at the 2007 peak, you watched it fall to roughly $50,000 at the March 2009 bottom. That's the reality of owning the whole market. Now, what about SCHD? Here's the honest answer. SCHD did not exist. It launched in 2011, so nobody can tell you exactly what it would have done, but its underlying index has been backtested through that period. Based on those backtests, SCHD's strategy, quality companies, strong balance sheets, reliable dividends, likely would have fallen less than the S&P 500, but only by a little bit. Maybe a drawdown in the 45% range instead of closer to 55. But let me be crystal clear. It still would have gone down heavily. We're talking about potentially losing 40% or more of your money on paper. No dividend strategy makes you bulletproof in a crisis like 2008. Banks were the epicenter of that crash and slashed dividends left and right. I even read somewhere on Reddit that someone replaced their bond ETF with SCHD, and that's crazy. SCHD is not like a bond ETF. Do not do that. It's not going to behave in a similar way during a crash like 2008. Now, this is going to be the hardest part that many people are going to struggle with: the recovery of these assets. The S&P 500 took roughly 5 years just to get back to its 2007 peak. That's a long, painful wait. And a defensive fund like SCHD falling less likely would have recovered its losses sooner. And this is the key insight of this video. Once the recovery took hold, the S&P 500's growth engine kicked in. The decade after 2009 was one of the greatest bull markets in history, powered exactly by the tech stocks SCHD avoids. So likely the full picture looks like this: SCHD's strategy loses less in the crash and gets back to even faster, but VOO, with its higher long-term growth rate, eventually catches up and passes it, and then pulls ahead over the full 15-year stretch. The real question is this: would you have actually held on through a 55% decline? Because the best fund in the world is worthless if you panic sell at the bottom. For a lot of investors, the fund that lets them sleep at night and keeps paying them cash through the chaos is the fund they'll actually stick with. So here's the bottom line. VOO is the growth engine, the bigger long-term number, but the wilder ride. SCHD, if you want income with a little growth, a smaller final number, but real cash flow and smoother. And honestly, a lot of smart investors just own both and let each fund do its job. I prefer VOO because I'm able to run my own indicators on it and know when to trim or to accelerate purchases because of its long historical data. SCHD is interesting in the fact that there may be that opportunity to rotate to that fund closer to retirement and collect that dividend and then slowly offload VOO. Drop your pick in the comments which you prefer and tell me why. If this breakdown helped you, subscribe for more no hype investing deep dives. And if you want my full portfolio and monthly updates to the Boring Money Club, link is in the description. If you want to see how I trade the S&P 500 using my indicators for the long term, click this video right here. I'll see you in the next one.